Hi everyone, this is just going to be a pretty quick video kind of going over how accounting works. Um, Hopefully we can learn something from it. I think it's really simplifies accounting so that it breaks it down to its most basic level so that people can understand. So there's really two things to know, or two statements when you're looking at some accounting financial statements that you kind of need to be aware of. The first one's the balance sheet. So the way that the balance sheet is kind of broken down is by this equation here. So assets equals liabilities plus equity. And it's kind of the first thing that you learn in accounting. So assets in accounting, assets have to always equal the liabilities plus equity. So a good example of an asset, or what an asset is something that can be used in the future to make you more money or prevent you from paying money. So a good example of that is cash. So with cash, you have it in your bank account, you can pay it to people, and hopefully by paying it to people, you can get them to do things for you, or you can buy things to sell and make you more money in the future. So that's why cash is a good example of an asset. The next thing on the equation is the liabilities. So liabilities are something that you owe to somebody else. And that you have to pay to somebody else in the future. So a good example of that would be, if somebody loaned some money to you and you had to pay them back, that would be considered a liability. And then equity is kind of just what's remaining. It's kind of the what's left in your business that you don't owe to anybody else. And so it also kind of accounts for what you've accumulated so far from the operations of your business and things that you've contributed to your business. Okay, so let's just go over a quick example of a situation where you would record some entries to affect the balance sheet. So if you want to go to AccountingExL.com/accounting, you can follow along with an example that's on the website, and that's the example that we're going to use to illustrate this. So let's say to start up your business, you need $100 to start up your business. So you go and you get $20 from your mom as a loan, and you're going to pay your mom back $20. So in that situation, you have a liability of $20 to your mom, and then you use $80 of your own money to contribute towards your business. So by the end of it, you have $100. So the way you get that onto your accounting ledger is through something called the journal entries. So you can see here that I have journal entries with debits equals credits. And just something to kind of keep in mind is that whenever we debit something, it affects the balance sheet. Whenever we credit something, it'll affect the balance sheet. And the other thing to keep in mind is that assets typically have debit balances, liabilities and equity typically have credit balances. So if we're going to account for this transaction, to get this $100 on your balance sheet, you're going to debit an asset, $100. You're going to credit the liability to your mom. $20. And then you contributed $80, so you have equity of $80. So you can see here that debits the $100 equals the credits $100. You can sum that up right here. Okay, so then your journal entries are recorded. So then what we want to do is show this on the balance sheet. So our asset is $100. liabilities are $20. Our equity is $80. And so we need to make our equation work. Assets equals liabilities plus equity. So to do that, down here we have liabilities plus equity. Add these two together. So now you can see our assets equals our liabilities plus equity. So that's kind of how the balance sheet works, and that's why they call it the balance sheet, is because the balances 100 equals 100. Okay, so the next step of this is the income statement. So on the income statement we have revenue minus expense equals income. The income statement can also be called, you might hear it called the P&L or the profit and loss or the statement of operations. But really this is kind of what it is. Revenue minus expense equals income. So if we go to AccountingExL, our example on here is where we're selling a car. So we're selling a car for $100. It costs $80 for us to make the car or to buy the car. So we have $80 of expense. And so the difference between what we're selling the car for of 100 and the cost of the car of 80 is $20. So we're going to have income of $20. So to do that, we kind of do the same thing with a journal entry. So we're going to sell the car for $100. So like I said before, we're going to debit and credit. So something to kind of keep in mind is that revenue typically has a credit balance, or typically it is a credit, and expense is typically a debit. So we're going to increase our revenue. So what we need to do is credit revenue for $100 for when we sold that car. And then since debits have to equal credits, we need another side to this entry. So we have a credit of 100, we need a debit of 100. So let's just say, okay, we sold this car, we got paid by the customer $100, so that's going to increase our cash by $100. I'm going to put asset next to this just so we don't get confused. So there's $100. So now our debits equal our credits. Okay, so the next step of this is that it costs us $80 to buy the car, to make the car, whatever. So to get that on the books, we want to debit expense with $80, and we're going to credit cash because we paid cash to buy that car, and then we sold it, or we paid some employee, to manufacture the car. Okay, so debits equal credits. And then the next step is to go ahead and show this on the income statement. So we want to show our revenue, $100. And we have expense of $80. And so our income is $20. All right. So these transactions have an effect on the income statement, but they also have an effect on the balance sheet, because here we have cash of $100. So we need to reflect that on our balance sheet. So to do that, we're going to, this is a debit to cash, $100. So we're going to increase our assets by $100. And then our next transaction, we have a decrease in cash, a credit of cash of $80. So we're going to subtract $80. Alright, so that's the effect on the balance sheet. So now you can kind of see that our assets are 120, but our liabilities plus equity is 100. So they don't balance right now. And the reason that is because of the effect of the income statement. So we have our net income here of $20. And sometimes, like if you have an accounting software and you run a balance sheet, you'll see this in the equity section of the balance sheet. So what we need to do is we need to account for this. So this is an accumulation of our earnings, which is going to show up in our equity. So to do that, we just add this $20 to our equity. And now our assets equals our liabilities plus equity. So that's kind of a general overview of how accounting works. This is kind of an accounting 101 course type thing. There's more to accounting than just this. There's different types of revenue, there's different types of expense, there's different types of assets and liabilities and equity. But overall, this is a basic understanding of how it works. So hopefully you think this is helpful. If you think it's helpful, give us a thumbs up, subscribe, go to AccountingExL.com, check out the website. Got a lot of useful tools on there to help business owners, things that we use ourselves. So hopefully this is helpful, and see you all next time.